Definitely another noisy quarter when you consider the government shutdown, ongoing tariff headlines, and then some softer labor data that came in along the way. I'd say November in particular brought about a pretty sharp equity pullback as we worked through a little more hawkish Fed signals and then the AI CapEx concerns. I know Anthony will touch on a little bit later. Tone certainly shifted here in December, but overall quarter to date rotation has continued with value and small cap categories outperforming and really highlighted by healthcare, energy, industrials, and financial sectors all positively contributing to market performance. The strength of the consumer has been called into question throughout the earnings season. Some of the larger detractors for our portfolio fell into that bucket. So Elf Cosmetics had a very noisy and disappointing earnings call. Their pricing challenges and declining organic growth expectations sent the stock down near lows that we'd seen earlier in the year. And then secondly, and similarly, the trade desk continues to wrestle with their own uncertainty in the overall advertising landscape. Their quarterly results were solid, but not really enough to put fears of Amazon's competition to rest. We need to see some clear line of sight towards our reacceleration and confidence in some of the new management team that's been put in place there.
Another stock that endured selling pressure was Axon, the public safety technology company. Expectations were high ahead of earnings results, as reflected in the company's price multiple, and the quarter was not strong enough to appease analysts who challenged the company's investments for future growth that are coming at the expense of near-term margins in cash flow. We did meet with the company during the quarter after earnings, and we came away confident in Axon's ability to grow at scale, their ability to grow organically and through mergers, as well as their upside potential through new initiatives around drones, AI, as well as international expansion. I'll start. And thinking about what's transpired over the past 3 years, namely the public debut of ChatGPT, AI has been the dominant discussion point within tech, which is a large percentage of many of our growth-oriented strategies. By and large, investors have rewarded the AI haves, they've shunned the AI have-nots, and they've jostled their positioning to anticipate any shifts between those two groups. I'll take AMD, for example. The semiconductor company was once considered a very distant second source supplier of accelerator chips, lucky to dine on any leftover scraps from the industry leader, NVIDIA. More recently, however, investors have come to appreciate AMD's positioning, their ability to meet increasingly demanding customer performance and energy efficiency targets, and they have come to appreciate the value of vendor diversity in the AI semiconductor ecosystem. We do believe that the risks and fears of vendor lock-in are real, which provides a viable seat at the table for AMD. And I'll move on to Alphabet, the parent of Google. They pioneered the transformer architecture that underpins the large language models that we all use on a daily or weekly basis. Despite their historical innovations for the underpinnings of AI, investors were increasingly frustrated by their lack of product development and their lack of commercialization of AI services. And that was up through earlier this year or summer when the company's progress in Gemini, the company's large language model, as well as deeper appreciation of Google's vast distribution network from search, from Chrome, through YouTube, and Android, investor perception on Google has shifted positively. Elsewhere in tech, Shopify, the e-commerce enabler, they navigated a treacherous retail environment as they serve as the technology backbone for merchants worldwide. The company reported strong revenue growth with strong traction in North America as well as regions in Europe. And we continue to hear that companies, big and small, are leaning on Shopify to drive sales and operate more efficiently.
Great night. I'll just add on. I called out the overall market strength in the healthcare sector, somewhat due to their defensive characteristics in a more uncertain environment. But two of our largest contributors in that space were due to very positive fundamental updates. So, first and most notable, Exact Sciences announced that they have agreed to be acquired by Abbott for $21 billion, which is a good result for a company. 50% premium to where it was trading before the initial leaks of the deal started spreading, and a really great opportunity for the combined now entity to continue executing on that strong foundation that Exact built in the early cancer detection space. Natera is another diagnostic company that was a strong contributor for us for the quarter. Revenues up 35% year over year and margins tracking towards the high end of guidance. The core Signatera product continues to gain traction with more and more doctors and oncologists across the country, and really encouraged by their early mover status in the MRD space. Both Exact and Natera, as well as a lot of new ideas that we're digging into, are really highlighting that increased attention and investment that's happening in precision medicine and personalized healthcare. I think the rapid advancements in our understanding of the human body, coupled with the integration of AI into diagnostics and services, are really opening up some structural shifts in the overall healthcare system and presenting some great new opportunities for us to uncover that are differentiated and distinct from the broader headline dominated AI themes that everybody else is talking about.
The short story is we're optimistic that AI will help us as people, as businesses, do more with less. And there are new inventions that we have yet to see that we could see new business models, new market leadership based on what has yet to occur. And that keeps us very excited about AI as a technology. We have heard calls, for a bubble, or a bubble bursting. They have increased, at least in intensity, and we caveat that, with the anecdotes and the feedback from the companies that we invest in and follow. That the major providers of AI infrastructure, the major web services companies that are integrating AI and machine learning into their business models, they continue to report that demand is outstripping supply, at least for compute capacity. And AI services, the services that we use, such as ChatGPT and Grok and Claude, adoption as well as awareness are continuing to increase. And so I think these are important data points, to refute that those calls for an imminent bubble bursting. That the technological ramp and adoption and usefulness is going the right direction. The key question we have asked over the past couple years is, where does the economic value flow? Today, it has been the picks and shovels providers, NVIDIA, as an example here. However, studying past technological cycles from the radio to internet to air flight, it's rare for the building block companies to capture the majority of economic value long term, at least in a sustainable sense. And so we could see shifts in market leadership over the future, and we are doing our hardest, our best efforts to identify and uncover and anticipate those inflections when they come. And so we think about the value of past technological innovations, as flowing to the end users. And that has been the historical precedent. And so we are continuing to monitor and evaluate how AI is used on an everyday basis. And the thinking about recent client interactions, are we in a bubble? I will paraphrase the famed bond investor Howard Marks when he said that not all exuberance is irrational, but we as investors have to be fully aware that historical precedents of market behavior, can result in challenging returns. And so we are watching very closely pricing dynamics, margin dynamics, cash flow trends, financing trends in the AI ecosystem. Yet we balance that diligence with the knowledge that excessive pessimism, excessive skepticism can prevent us from identifying and owning the generational wealth creation opportunities that could present themselves. And so we are continuing to do work on the AI ecosystem, and we are finding opportunities not just with semiconductors, but all the adjacent areas today.
Yeah, I think that's a good introduction and segue to really start with Tesla, which we believe is becoming more and more clear that they are an AI company. And as they continue to expand the robotaxi network and update their full self-driving software stack, closer tracking themselves closer and closer to full autonomy, realizing that this bridge from artificial intelligence into the real world is happening, and Tesla should be one of the largest beneficiaries and enablers of that. Other fundamental updates for Tesla: Elon's compensation package was approved during the quarter by shareholders, which was a positive, and then earnings were also supported by a good pull forward in demand for EVs ahead of the tax credit expiration, as well as continued strength in their energy business. Really excited about 2026 for the company, setting up to be a very catalyst-rich year. We've seen job postings indicate that Cybercab production is on track. Optimus, of course, continues to progress and look forward to more updates there. And then expect to see multiple new robotaxi markets launched across the country. All these things leading to very strong acceleration in overall fundamentals for the business. Moving on from Tesla, a couple other things. I think as Anthony touched on, the AI funding environment remains very robust, but capital markets activity has not been isolated to AI. Touched on Abbott buying Exact earlier, but in total, 2025 deal value is up 36% year over year. Like most recently and topically for us in our portfolio was Netflix's announced acquisition of Warner Brothers for $82 billion. Consolidation in the media landscape, certainly not new. Like it is an interesting phase of history now with technology-focused streaming companies really leaning into their strength and taking more share in the space. Do expect the regulatory process to drive headlines over the short term. I think it's going to be very interesting to see how the market is going to be defined. If it's narrowly defined to just streaming providers, then the antitrust case might be challenging. But if you look at overall total TV viewing, then the combined entity represents less than 10% of total domestic viewing time, placing this new company comfortably behind both YouTube and Disney. Like Netflix has proven an unmatched ability to maximize the value of content that they get their hands on. And this new library of assets that Warner Brothers and HBO bring to the table is very exciting for the long-term combined offering. And then finally, just wrap up, I think all the M&A activity has also been further complemented by a healthy IPO calendar. Number of IPOs year to date is up almost 50% from last year. So further acceleration from the 2022 and 2023 low periods, but still well below that 2021 peak. I think it's hard for us and for anybody to miss the headlines surrounding SpaceX and their rumored valuation and potential for a 2026 IPO. So we'll definitely be actively tuned into further developments there, but do expect the timing to remain very flexible. I think in the meantime, space is an exciting area of investment for us. Last call, we called out Rocket Lab and still believe that the vertical integration and launch capabilities that they offer set up very strongly to capitalize on any further market expansion opportunities or adjacencies. Elon, Google, and Jeff Bezos have all started advocating for a future where data centers are primarily operated from space. And while that may still be a few years out, it is impossible for that to happen without companies like Rocket Lab offering consistent, economically viable cadence of launch operations.
A year ago on a call, you're thinking about the year ahead. So thinking about 2025, I called the year of resourcefulness. And that was largely accurate. Companies tightened their focus and pivoted away from less strategic and moonshot areas in the face of significant political, economic, and technological change. Looking back in hindsight, 2025 could have been the year of resilience, that consumers continue to spend, businesses continue to demonstrate earnings growth and profits, the economy continued to grow. And that was all within the backdrop of negative sentiment indicators. And so now, as we think about the year ahead, 2026, I'm gonna take a leap and say it's going to be the year of rotation. We continue to believe in power law, in network effect dynamics, in tech and in tech adjacent industries, favoring companies with talent, scale, data, distribution, and capital. All of those traits encapsulate the Magnificent Seven, the group of mega cap stocks that have driven a large disproportionate share of broad market returns as well as earnings growth. With that said, we are starting to see what we would consider a healthy scrutiny, of AI businesses and the path to earn a viable return on investment of AI infrastructure. And I believe that as companies, AI natives, legacy companies pivoting into AI areas, as they work to prove that there is a return on that investment, investors are likely to pivot into areas that have been shunned or left for dead, so to speak. And that should favor broader market participation, wider breadth, and and strategies that are all cap in nature and go where the growth is, and not necessarily sector constrained. And so we are optimistic, in our positioning. We're optimistic in our portfolio companies as they execute in large and expanding markets. We're uncovering underappreciated and misunderstood ideas that could have compelling returns and drive significant wealth creation over the years to come.